Hey guys, this is Dawson Discussions, and I'm your host, Nathan L. Dawson Jr. Today's date is December 26, 2021. In this episode, I will be sharing with you what I look for in stocks before I consider investing in them. So essentially, this small video series is actually going to be broken down in phases due to time constraints. So it's actually, what I actually look for is the qualitative analysis, the quantitative analysis, valuation, margin of safety, and lastly, the technical analysis. So essentially, this video is actually going to be qualitative analysis, again, due to time constraints. So stay tuned. So here is a little bit of information on stocks. Essentially, a stock, also known as equity, is a security, which is a tradable asset that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a proportion of the corporation's assets and profits equal to how much stock they own. Unit of stock are also called shares. Corporations issue, as in they sell stock, in order to raise funds to operate their businesses and grow and expand and whatnot. The holder of a stock, also known as the shareholder, has now bought a piece of the corporation, and depending on the type of shares held, may have a claim to a part of its assets and earnings. Because you're a part owner of a company that issues that stock, when the company makes money, you make money. And the same is actually true in the opposite. When the company stock price goes down, then you start to lose money. So there are actually two ways to make money in the stock market: through capital gains or through dividends. The term capital gain refers to the increase in the value of an asset that you own when it is sold. So put simply, a capital gain occurs when you sell an asset for more than what you originally paid for it. So if you buy a stock at $50 and it increases to $250 and then you sell it, then the $200 is the difference, and that is your capital gain. The U.S. taxes short-term capital gains at the same rate as it taxes your ordinary income, but long-term capital gains are taxed at a much lower rate. The second way to actually profit from the stock market, as I alluded to earlier, is through a dividend. So the company can also choose to issue out a dividend to its shareholders. A dividend is a distribution of profits by a corporation to its shareholders. So once a corporation earns a profit or surplus, it can actually have the ability to pay a proportion of the profit as a dividend to its shareholders. Any amount not distributed is then taken to be reinvested in the business, and this is called your returning earnings. So essentially, the United States and also Canada and probably some other countries maybe out there impose a lower tax rate on dividend income than ordinary income on the assertion that company profits have already been taxed as corporate tax. Although there are some investors out there that believe that the company profits are best reinvested in the company because they want to see more research and development, capital investments, expansions, mergers, acquisitions, and whatnot. And proponents of this view, and thus the critics of dividends per se, suggest that an eagerness to return profits to shareholders may indicate the management having run out of good ideas for the future of the company. Some studies, however, have demonstrated that companies that pay dividends have higher earnings growth, suggesting that dividend payments may be evident of confidence in earnings growth and sufficient profitability to fund future expansion. And there you have the two ways that people can actually profit from the stock market. Okay, as I said in my intro, here is phase one. Phase one is called the qualitative approach. Qualitative analysis uses subjective judgment to analyze the company's value or prospects based on quantifiable information. So my qualitative analysis has actually been inspired from an investor named Phillip Arthur Fisher. He was the author of Common Stocks and Uncommon Profits. His most famous investments was his purchase of Motorola Incorporated, a company that he bought in the year 1955 when it was a radio manufacturer, and he held until his death in 2004. Motorola Incorporated started in September 25th, 1928 and went defunct in January 4th, 2011. In January 2011, Motorola split into two separate companies, each still using the word Motorola as part of its name. One company, Motorola Solutions, using a blue version of the Motorola logo, is based in Chicago, in the Chicago suburb of Schaumburg, Illinois, and concentrates on police technology, radios, and commercial needs. The other company is a Motorola Mobility using a red logo. It's also based in Chicago, formerly in the Chicago suburb of Libertyville, Illinois, and is the mobile handset producer. The split was structured so that Motorola Solutions was the legal successor of the original Motorola, while Motorola Mobility was a spinoff and was succeeded by perhaps perhaps the best known of Fisher's followers is Warren Buffett, who has said on some occasions that he is 85% Graham and 15% Phillip Fisher. Okay, and back to my qualitative analysis. Okay, so the very first thing I actually look for is the company description. So essentially what I consider is what sector it is in. Is it communications, consumer discretionary, luxury goods, consumer staples, which is our basic necessities, energy, financials, healthcare, industrials, information technology, real estate, or utilities? Reason being is because certain sectors respond differently to the business cycle, which is intervals of expansion followed by the recession in an economic activity. So utilities and consumer staples are what we call defensive sectors. A defensive stock is a stock that provides constant dividends and stable earnings regardless of the state of the overall market. There's a constant demand for their products, so defensive stocks tend to be more stable during the various phases of the business cycle. Defensive stocks should not be confused with defense stocks, which are stocks of companies that manufacture things like weaponry, ammunition, fighter jets, and ships. Well, warships, actually. Consumer discretionaries are good examples of cyclicals. A cyclical stock is a stock that's price is affected by the macroeconomic or the systematic changes in the overall economy. Airlines, like American Airlines, cruise ships, Carnival, like the Carnival ship company, cruise ship company, and automobile manufacturers like GM, Ford, and Tesla. Another thing that I also look for is the industry. Essentially, the industry is the subsector of the sector. Industry refers to a much more specific group of a company or businesses. And industry is a group of companies that are related based on their primary business activities. So artificial intelligence, electric vehicles, space exploration, financial technology, or you know it as fintech, FINTECH, data science are all examples of industries. And then you also have the restaurant industry, the hospitality industry, and so on and so forth. So when analyzing these stocks, and also being inspired from Phillip A. Fisher, I also want to ask myself, is the company in a growing industry to make possible sizable increases in sales for at least several years? So minor examples would be Amazon and eBay, both of whom have benefited mightily from the internet revolution. As the internet has begun to grow, so have those companies. And when the company actually grows, so does their fortunes. Some of their success can certainly be attributed to excellent execution, but these companies' long-range sales curves extended as more and more people embrace online shopping. On the other hand, if you remember Heelys, which was the shoes with the built-in wheel, over time, Heelys, the stock price, it was very high, and then over time, since Heelys didn't really pivoted, then the share price actually went down. So you actually want to avoid fast and one-hit wonders. Crocs also went through the same issue as Heelys, but with the history of the company based on its cash conversion cycles, they've actually reinvented themselves into a real shoe company, and now they're actually growing. Another question I actually ask myself is, what is the quality of the product or the service itself? If the company produces a consumer product, investors can actually read online reviews of the product to judge how consumers view the company's product or service. So if you are researching a brick and mortar retailer, try to walk their stores. If you're researching a restaurant chain, try eating at the restaurant. If you're researching a software company, try to use that software. And investors should research how the company's products or service compares to the competition and how it's viewed by the customers and other consumers. Does the company have determination to continue to develop products or processes that will still further increase the total sales potential when growth potentials of currently attractive product lines have largely been exploited? Essentially, what this means is all markets will eventually mature, and to maintain above average growth over a period of decades, a company must continuously develop new products to either expand existing markets or to enter new ones. For example, Microsoft Windows 1.0 was released in 1985. Over the years, Windows actually became a little bit more sophisticated. And now when Windows actually created Windows 11, then that released in 2021. The same thing can actually be said with Xbox. We had Xbox, the original Xbox 360, and now currently we have Xbox One. The same can also be said for Sony. Sony had PlayStation 2, PlayStation 3, PlayStation 4, and PlayStation 5. The same thing with Apple. Apple had its iPhone, and then now we have the latest iPhone model. Same thing with Samsung. Same thing with the Samsung Galaxy series and the Samsung Galaxy Note series. How do consumers perceive the brand? The term brand refers to a business and marketing concept that helps people identify a particular company, product, or sometimes an individual. Brands are usually intangible, which means you can't really touch or see it. As such, they help shape people's perceptions of companies, their products, and the individuals using them. Brands often use identifying markers to help create a brand identity within the marketplace. Companies with a valuable brand really don't need to fight as hard in order to attract customers right back to their business in order to make those repeat purchases. And repeat purchases can actually create a steady stream of recurring revenue. Coca-Cola is a very popular soft drink brand. Starbucks is a very popular coffee brand. Tesla is a very popular electric vehicle brand. Hershey's is a very popular chocolate brand. And Harley Davidson, I think is, if I'm saying the name correctly, is a very popular motorcycle brand. What is the market share of the company? Market share refers to a proportion or the percentage of a market earned by a company or an organization. In other words, a company's market share is its total sales in relation to the overall industry sales of the industry in which it operates. For example, the purchasing activity of consumers as a whole is 100 tubes of toothpaste, and Colgate-Palmolive company maker sells 60 tubes. It implies that Colgate-Palmolive company holds a 60% market share. The calculation of market share takes into consideration companies' total sales over a particular time period and the total sales of the industry in which it operates over that period. So essentially, you want to invest in companies that actually have a much higher market share in relation to its competitors. Okay, part 2, management and corporate governance. And with the saying from Uncle Ben from Marvel, with great power comes great responsibility. Management is essentially the administration of the business. It includes the activities of setting the strategy of an organization and coordinating the efforts of its employees or volunteers to accomplish its objectives through the application of available resources, such as financial, natural, technological, and human resources. An effective management team is crucial to the success of a business. The decisions of a company are made by management, so any misuse of funds will affect investors. An experienced management team has the best chance to lead a company into a prosperous future. Corporate governance is necessary because of the possibility of conflicts of interest between stakeholders, primarily the shareholders and upper management, or among other shareholders. It is a collection of mechanisms, processes, and relations used by various parties to control and to operate a corporation. Governance structures and principles identify the distribution of rights and responsibilities among different participants in a corporation, such as the board of directors, managers, shareholders, the creditors, auditors, regulators, and other miscellaneous stakeholders. And also includes the rules and procedures for making decisions in corporate affairs. So one of the questions I actually asked, again, inspired by Phillip Arthur Fisher, does the company have a management of unquestionable integrity? The key word here is unquestionable. A management team that has any history of dishonesty, fraud, or ignoring shareholder interests will likely repeat this behavior in the future, and you don't want to be in their way when they do so. Because of company filings, there are plenty of ways to analyze management track records and behaviors at current and former companies. The key here is when in doubt about a management integrity, just walk away or liquidate your shares and move on to a different company. Does the management team talk freely to investors about its affairs when things are going well, but they clam up when troubles and disappointments occur? Try to take a look through the company's reports and conference call transcripts following a particularly poor quarter or year. Is the management forthcoming about the mistakes they made, or is everything sugar-coated and blamed on the economy, weather, markets, the customers, and the government? If management takes ownership for the company's underperformance and thoroughly explains the steps they're taking to improve the business and their operations, you just might have a winner. Does the company have outstanding labor and personnel relations? Phillip Arthur Fisher once wrote, "The company that makes above average profits while paying above average wages for the area in which it is located is likely to have good labor relations. The investor who buys into a situation in which a significant part of earnings come from paying below average wages for the area involved may in time have serious troubles on his hands." So essentially, you want to look at turnover and wage distribution. Are workers hired en masse and laid off as quickly based on the business outlook? If nothing is done to build up on the dignity of the individual, this may not be a desirable investment or even a place just to work. A company with good labor relations tends to be more profitable than one with mediocre relations because happy employees are likely to be more productive. There's really no single yardstick to measure the state of a company's labor relations, but there are a few items investors should investigate. First, companies with good labor relations usually make every effort to settle employee grievances quickly. In addition, a company that makes above average profits, even while paying above average wages to its employees, is likely to have good labor relations. Finally, investors should pay close attention to the attitude of top management towards their employees. Does the company have outstanding executive relations? The company offering the greatest investment opportunities would be one in which there is a good executive climate. Executives have confidence in the president and the CEO, and that salary and promotion are based upon ability, merits, and results. The further a corporation departs from these standards, the less likely it is to be a really outstanding investment for you to make. Management is hired from within. Excessive management pay packages is certainly cause for concern, but at the same time, you also want the management and the executives to be appropriately compensated. Just as having good employee relations is important, a company must also cultivate the right atmosphere in its executive suite. Fisher noted that companies where the founding family members retain control, family members should not be promoted ahead of more able executives. In addition, executive salaries should be at least in line with the industry norms. Salaries should also be reviewed regularly so that merited pay increases are given without having to be demanded. So essentially, I would prefer for the CEO to own at least 30% of the shares because it shows commitment to the company. Otherwise, they'll have one eye on the business and another eye out the door, out of the company. Does the company have depth to its management? As a company continues to grow over a span of decades and entering new markets, it is vital that a deep pool of management talent is to be properly developed and groomed. Fisher warned investors to avoid those companies where top management is very reluctant to delegate significant authority to lower level managers. All humans are infinite, although some are exceptionally outstanding. There comes a time that Phillip Fisher writes, sooner or later, a company will reach a size where it just will not be able to take advantage of further opportunities unless it starts developing executive talent in some depth. Good executive material becomes much like healthy young animals, so caged in that they cannot exercise. They do not exercise their faculties because they do not have enough opportunities to use them. So essentially, C-level executives, have they been employed in a company for several decades, and have they had long tenures as C-level executives? For example, the CFO or the chief financial officer actually have served under 4 CEOs, for example. Also, how does the company view buybacks versus dilution? What is the attractiveness of borrowing capabilities of the company? Phillip Arthur Fisher goes on to talk about conversion privileges being assumed as converted due to the horizon of the investment and explain how per share earnings is impacted in the future due to dilution outstripping growth gains. Stock buybacks is essentially what he's referring to. So stock buybacks refer to purchasing of shares of company by the company that issued them. A buyback occurs when the issuing company pays shareholders the market value per share and reabsorbs that portion of its ownership that was previously distributed among public and private investors. So with those buybacks, the company can purchase the stock on the open market and from its shareholders directly. And in recent decades, share buybacks have overtaken dividends as a preferred way to retain cash to shareholders. Though smaller companies may choose to exercise buybacks, those well-established blue chip companies are much more likely to do so because of the cost involved. Also, those highly competitive companies are a profit generating machine. This causes the issue of what to do with the excess money. One of the options is to buy back the company's own shares. This reduces the number of outstanding shares, which increases the remaining shareholders' portion of the company. Fewer shares also can create an increase in earnings per share. A history of stock buybacks is a good indicator of a durable competitive company. As long as that company isn't using debt to buy back its shares, it shows that the company is generating excess cash and is looking for a place to invest that money. Moving on to the third point of my qualitative analysis: research and development. Research and development, also known as R&D, are the set of innovative activities undertaken by corporations in developing new services or products and improving existing ones. R&D is very difficult to manage, since the defining feature of research is that the researchers don't really know in advance exactly how to accomplish the desired result. As a result, higher R&D spending doesn't always guarantee more creativity, higher profit, or a greater share in market. So essentially, how effective are the company's research and development efforts in relation to its size? The quality of the human talent at a company is just as important as the quality of the management team. Not every company will be the next Apple, the next Google, the next Amazon, the next Tesla, the next Microsoft, the next Pfizer, the next Coca-Cola, or anything else like those companies that we are familiar with. But it is very important for a management team to foster a culture of challenging the status quo and trying out new ideas. If a company places a high priority on research and development because those smaller companies and not so much with the larger companies, it is likely that they will roll out a successful introduction. And if that product and service takes off, then so will the price of the stock. A company that is well established and is a leader in its industry can spend less on R&D and still have the same effectiveness, whereas a weaker competitor will have to outspend a number one competitor to try and develop something better to become well established as the leader is. But if a competitive advantage is created by a patent or a technological advantage, at some point it's going to disappear. High R&D usually dictate SG&A, which is the selling, general, and administrative, which threatens the competitive advantage, as thought by Warren E. Buffett. Looking into the program management is implementing completion times, crash program history, and industry comparison, and reviewing R&D expenditures versus the sale they produce will be beneficial to the intelligent investor. If a company has a proven track record of producing products or services through research that has become profitable, it is more than likely that they will continue this in the future, provided that they adhere to the same principles. And the fourth point that I actually look for in my qualitative analysis, and this is also one of my favorites to actually to know about my businesses that I actually do consider investing in, would be the competitive advantage and or the economic moat. A company that is ahead of the pack will be on the top of cutting edge trends and industry changes in areas like marketing and technology. You want to single out those companies that are and likely to stay one step ahead of the competition. This is called an economic moat, again coined by Warren E. Buffett. That unique, sustainable advantage that keeps competitors away and allows a company to generate higher than average profits. The wider the moat, the longer a company's financial success should last. Within any given industry, companies are constantly trying to take market share away from each other. So McDonald's compete with Burger King, who also competes with Wendy's, and also Wendy's compete with those other burger restaurants, also trying to compete with Rally's and Checkers. And the fried chicken industry, Popeyes competes with KFC, that competes with Church's. Also in automobile making, GM competes with Nissan, which competes with Ford, which competes with General Motors, which competes with Tesla. Same thing with e-commerce. Amazon competes with Shopify, who competes with eBay, who also competes with Etsy, and so on and so forth. So the very nature of capitalism is competition. I mean, yeah, because they're not trying to really make a monopoly, but they're just trying to compete. And Uber competes with Lyft, and I can go on and on and on with competition. So, for a company to avoid ceding their respective market shares to its competitors, the company has to create a very strong competitive advantage. Competitive advantage can come in the form of a product or a service that is so difficult to replicate, a cost structure that is superior to peers, a brand image that is superior to peers that your competition just can't keep up, and then they're just either gonna give up and find something else in order to outperform your investment. So Phillip Arthur Fisher asks, are there any aspects of the business, somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? So one economic moat that I probably mentioned earlier is a strong brand name. One of the most effective and tangible assets are a strong brand name, especially when they're used in everyday language. For example, when people say just Google it for searching something on the internet, give me a Kleenex for tissues, Photoshop it for any sort of image editing, which is owned by Adobe, or a polo shirt for a collared shirt, or a Coke for a cola drink, Coca-Cola, or FedEx in order to ship something, FedEx. This is the kind of moat that is really only possible because these companies have dominated that space for so long that customers began using the company's product or service brand name instead. Obviously, this produces a huge distinctive competitive advantage that other competitors may never be able to cross. However, strong brand names recognition is not limited to just everyday language. The Coca-Cola Company, for example, have created a massive brand name over time, proven by the number of sales it receives on its signature Coca-Cola drink every year. Even its closest competitor, PepsiCo, and its signature Pepsi drink has never came close to beating Coca-Cola's signature Coke drink in sales or market share. Another example is complexity. Processes that are very unique and difficult to imitate are good modes as they tend to be durable. Again, going right back to Coca-Cola. Coca-Cola syrup creates a signature taste of the cola soft drink, which is very difficult to copy. Even Pepsi, they haven't really. I don't think Pepsi even knows Coca-Cola's recipe. And then the same can also be said with Popeyes, because I think Popeyes, they also say that they have their signature herbs that they use for their chicken. And I think KFC probably also doesn't know their secrets. So those are probably two complex examples on an economic mode for their product that no other company can actually replicate. Another example would be protection. A company's products can be protected through patents, copyrights, trademarks, operating rights, licensing, and whatnot. For example, Mickey Mouse, which is copyrighted and trademarked by Disney, has been bringing in profit through merchandising of shirts, hats, and jewelry for many years. Without intellectual property rights on those characters, Disney may not have been one of the most dominant entertainment companies in the US. The perfect example also might be Nike, which started out as a simple athletic apparel company, but has since become a major cultural institution and a purveyor not only of gear but of status. Designer fashion labels have similar business models. LVMH, Louis Vuitton, for example. Also, patents in the US are generally granted for 20 years from the date the patent application is filed. So patent moats are not always the strongest. Example of these are pharmaceutical companies who get their moats from patents on drugs, or technological companies like Intel that get their moats from patenting their computer chips. Another example of a economic moat, switching costs. Switching costs are costs that a customer has to bear if they want to switch to another product or service. As the switching cost increases, the customer becomes more locked in within the company. Switching costs can also come in the form of loyalty points or the inconvenience of switching. For example, while there are no fees associated with the processes of switching banks, it is simply an inconvenience for a person to set up new accounts and portfolios at a different bank or a different brokerage. The inconvenience associated with the process ties the customer to the original bank. Most people that use a computer will probably have either a Windows or a Macintosh with their operating systems. Now, there's a high switching cost here for many customers, especially with the software installed, Microsoft Office, and its many industry standard products and services, which creates an economic moat for both Apple and Microsoft, respectively, that other competitors have failed at beating. Apple as a whole makes a very specific ecosystem where other Apple products can easily be connected to others just by turning them on. No one else really has this to an extent, which is one reason why they are able to charge a premium of many of their products and services. And I think the same thing with Adobe, because you have Adobe editors and Adobe video making and Adobe Photoshop. And then again, where I said with the name Photoshop earlier, as for an example of a everyday language moat. Another example is economies of scale. Boeing is one of the biggest aircraft manufacturers. Boeing has the ability to buy in bulk, and as a result can get cheaper prices when ordering materials. They're also able to adapt to demand by opening, closing manufacturing centers, or hiring and laying off people to meet this demand. On the other hand, smaller aircraft competitors may have to take on large amounts of debt and not only able to quickly capitalize on demand or efficiently produce goods for their customers to the extent that Boeing can, simply because of the cash flow and economy of scales they have built up over time. Another example of an economic moat is cost advantage and or superior pricing power. Companies that can deliver or produce their goods or services at a low cost have a major advantage over the competition because they can undercut their competitors on price. Companies with long-term sustainable cost advantages can command and maintain a large market share within their respective industries, thus forcing competitors out. Walmart is a very good example of a company that maintains a cost advantage in part by buying and selling huge volumes of goods. Meanwhile, Apple leverages its brand power to squeeze lower prices out of its suppliers, which are eager to do with this titan of consumer tech. Many massive retail stores like Walmart, Costco, Target sell their items for very low prices, which other smaller businesses just cannot compete with. Same thing with Facebook. Meta, they own WhatsApp, which is a free messaging app. Same thing with this acquisition of Instagram, also mostly free. Another example is the network effect. The network effect is when the value of a good or service grows as more people use them. One thing that may come to your mind are social media platforms. For example, Alphabet. They own Google, and Google in turn owns YouTube. YouTube only began with a few videos, but once Google bought it, and as more users began to post their videos on YouTube and more users began searching for videos, YouTube grew exponentially and has only seen its user base grow over time. Currently, there is no real competition in sight for YouTube, largely because of the massive amount of capital and resources it would require for other companies to gain significant market share in the online video sharing space. If no one really used those platforms, then they will hold very little to no value whatsoever. However, because many people actively use these platforms, it has created a very strong economic moat for those companies that competitors may never be able to replicate. Another example, certain marketplaces. One marketplace example is Amazon, which has managed to create a massive network due to the supply and demand created by suppliers and customers on their platform. This network effect ultimately enabled Amazon to leverage this positive feedback loop from users on the website to become a massive e-commerce marketplace. Another example is Uber, how the service attracted drivers by offering a source of income and attracted customers by offering a source of reliable transportation. Together, this created massive growth for the company, and although it's very similar to the many drive-sharing companies like Lyft, the company Uber still has an economic moat due to the network of Uber drivers and riders in thousands of cities globally, which takes a lot of time and capital to achieve. And the last example I can think of is a toll mode of some sort. So a toll mode is when a business is a sole supplier of something the customer needs, kind of like a monopoly. For example, streaming services. An example of a toll mode is Netflix or Disney through Disney Plus, and original content they provide on the subscription-based streaming services. Although there is content on Netflix and Disney that is available elsewhere, Netflix and Disney originals that are exclusively to Netflix and Disney require a subscription in order to have access to that show or movie. If many customers find this exclusive content to be very valuable, then this is an economic moat that is challenging to beat. However, streaming services moats like the ones that Netflix and Disney offer really do not last forever, and consumer media consumption preferences can always change. Okay, and moving on from economic moats, now here's just one last thing that I actually look at, and that would be institutional ownership. Institutional ownership is the amount a company's available stock owned by mutual funds, pension funds, hedge funds, insurance companies, investment firms, private foundations, endowments, and other large entities that manage funds on behalf of others. If a company is supported by a small handful of institutions with above average performance, it may be a good choice for you. However, if there are too many institutions involved, then it really isn't a good buy. Remember, you want to be there before lots of institutions are invested in a company. As a result, when those institutions do invest, they'll end up raising the stock price and your profits. And if the institution starts to sell, then the stock price is going to go down. So questions that I actually ask myself is, does a stock have a substantial level of institutional ownership? You want to see at least 30% of institutional ownership, so you know that the company is at least on the radar for institutional buyers. As investment companies have the most buying power, they are in position to make the most significant impact on stock prices. If the company is not attractive to investment firms, then the chances of the stock prices moving significantly higher or negligible. For example, in October 18, 2021, Barclays downgraded Walt Disney to equal weight because streaming subscriber growth is slowing and Disney shares dropped. Disney Chief Executive Officer Bob Chapek last month before October, which was September, hinted at a slowdown in Disney Plus, saying fourth quarter global paid subscribers will grow by low single-digit millions, compared with a rise of 58.5 million in the previous 3 months. Another example, March 17, 2021, PayPal shares dropped after Bernstein downgraded stock amid rising competition. PayPal shares sank with more than 5%. During that Wednesday, after Bernstein analysts downgraded the stock from the equivalent of a buy to a hold and cut the price target to 220 from 260, citing fears that the company faced a broad array of risks. Shares of PayPal were down almost 30% for the year, while the National Association Securities Dealers Automated Quotation Composite Index was up 25% at that time. PayPal's positioning as a leading digital wallet in an increasingly digital world is hard not to acknowledge. One of the reasons they upgraded the stock 2 years ago that a Bernstein analysis wrote. That said, we believe change is accelerating, and PayPal now risks getting disruptive versus being a disruptor. Bernstein analysts are concerned about the rising concentration of e-commerce around big platforms like Shopify and Amazon, which account for 32% of the U.S. e-commerce market. And lastly, December 9th, 2021, Jefferies downgraded Southwest Airlines, citing inflationary pressures. And there you have it. That's the qualitative considerations that I look for before investing into a stock. Now, the second phase of my video is actually going to be the quantitative. Quantitative meaning the numbers. And by the numbers, I mean, income statements, balance sheets, and statement of cash flows. So again, this is Dawson Discussions. My name is Nathan Dawson Jr., and I will see you in the next video, my quantitative analysis.